Okay, so welcome to this live session 7, and we are in the post midsem part of our course. In the pre-midsem, we have covered certain types of derivatives, which are the so-called non-contingent claims. So in non-contingent claims, there are basically three types of derivatives. One is forward, other one is swap, and these two are something like over-the-counter options. In short, they call it as OTC. And future is also another type of derivative, which is more like forward, and it is traded on exchanges, and therefore it's more safe from the default point of view, in the sense that both the buyer and seller, they have less risk on the other party's default, because exchange is involved in it. Therefore, they will regulate the trades to take care that there is no default. So therefore, in that sense, future is more an organized trading platform. So these are non-contingent, means at the time of initiating the contracts, that is at t equal to 0, we don't need to pay any price to own the contract. The buyer need not pay any price to own the contract, and therefore the buyer will have both right as well as obligation, just like the writer or the seller of the contract. So at the end of the day, that is at the end of the expiration day, both of them have to settle their contract without fail. Okay, so whether it is in favor of one side or not, that person has to settle it. Okay, so that is why it is called non-contingent claim. Another type of derivative is contingent claim. Okay, so the only example in contingent claim type of derivative is the options. They are mostly traded on the exchanges. In this, the writer, that is the seller of the contract, has to settle the contract at the end of the expiration, irrespective to whether it is in favorable to the writer or not, provided if the buyer demands that. Okay. Whereas if the market situation, that is underlying assets price, is not in favor of the buyer, okay, then buyer can simply leave it without settling it. Okay, say for instance, this contract is to buy a stock S, say for instance. Okay, the writer says that somebody can come and buy this stock, okay, and buy this stock at some price. Okay, say this stock is trading at 100 rupees on that day when they issued it, and the other side of the contract is the buyer of the contract. Okay, what is his contract? He will come to this W and buy this stock on some date. Okay, say 31st of March. Okay, so the buyer's deal in this contract is to buy this stock on 31st of March. Okay, on 31st of March, suppose if the stock price is 95 rupees, is the market price of the stock, then buyer will be in loss if he goes to respect this contract and buy it from W, because W will sell it for 100 rupees. Whereas if he goes to market, it is only trading at 95 rupees on 31st of March. Therefore, on the expiration date, that is on 31st of March, the trade is not, or the contract is not going to be in favor of the buyer. So in such case, if he has taken future or forward, he anyway has to respect it and bear this loss of 5 rupees. Whereas in option, the buyer can simply forget this contract. He need not execute. He has right to only execute. Suppose if the market price is say 110 rupees, then it is favorable to the buyer, whereas writer, it is not favorable. Writer cannot say, no, I don't want to respect this contract. He has to respect it, whereas buyer, since it is favorable in this case, he will go to execute the contract. Therefore, if the trade is in favorable to the buyer has to execute the contract. If it is not in favorable to the buyer, then buyer can simply forget it. Okay, he can just tear the contract, throw it off and go. Okay, so that little bit of advantage is there if he goes for the options rather than futures or forwards. Okay, to enjoy this small advantage, that is having only right but no obligation. This is what we meant by saying right but no obligation. You have to understand it correctly. It means if the trade and the expiration is in favor of buyer, he has to execute the contract. If it is not favorable, then he need not, generally it will not be executed on the exchange. Okay, so that contract will simply go worthless. Okay, so that is how the option works. And since the buyer is holding that advantage, he has to pay a premium. Okay, so that is what is cost that he pays in enjoying this right but no obligation. Okay, so the holder has to pay premium at the time of agreeing the contract. That is, at the time of buying the contract, the buyer has to pay a premium and then buy the contract. Okay, so and that premium will go to the writer or the seller. Okay, writer is also called the seller in this case. So the premium will go to the seller, and the right but no obligation luxury will stay with the buyer. And that is how the contract goes. This is the only difference between the future or forward when compared to options. Okay, in future and forward, at the time of executing or initiating the contract, neither of the parties will pay any premium. Okay, they simply make a contract and that's it. All the settlements will be done at the expiration. Whereas in options, expiration will happen at expiry, at least in certain cases. But at the time of initiating the contract also, the buyer has to pay the writer some premium. So that is what is called contingent claim option. Okay, the only example of the contingent claim is option. Okay, in fact, in that way, option is equivalent to contingent. Okay, so there are two types of options. One is call option and another one is put option. In call option, the buyer has right but no obligation, of course, to buy an underlying asset at the strike price on certain date. Say, let us generally we denote it by capital. Okay, whereas in put option, the buyer of the option has the right to sell the underlying asset. Okay, so he has the right to sell the underlying asset at the strike price on certain date. That is called the maturity date. Okay, generally we take the time at which the contract is initiated as t equal to 0, and then the expiration date as capital T, and the strike price as S of T. Oh, sorry, that generally we call this as K. I think this is some typo. We generally mention it as K in the theory, and the contract size is generally called lot. Okay, so that is how these are some of the notations and notions that we have to use. Apart from that, as I told, we will be using the notation S of T or S suffix T for the underlying asset. So the underlying asset can be anything. It can be index itself, or it can be currency, or it can be stock, or anything. But in all our discussions, we will just keep stocks in mind and talk. More or less, things will be the same for other assets also. And as I told, the strike price is denoted by K. Expiration is denoted by capital T, and the period is generally from 0 to T. Okay, so these are the basic parameters to define one particular option. And of course, you have to mention also whether it is call option or put option. Okay, because that defines in what way the trade has to happen. Clearly, the owner, that is the buyer of the call option, have to execute the contract at the expiration when K is less than ST, right? Because the call option owner has the right to buy, right? Buy the stock. So his contract says he can buy at the price K. Okay, at the expiration time, if the market price is more than K, then he is in profit. Then only he will go to buy it from the contract person. Otherwise, he can simply buy from the market itself, right? So why should he go to buy it from the contract? So if you are owning a call option, then you will execute the option only when the strike price is less than the current market price at the expiration. Of course, we will come to what is meant by European option little later. Time being, you just ignore that. And for put option, it's the opposite, because you are going to sell your asset. Therefore, your strike price should be more than the market price. Otherwise, it's more profitable for you to sell in the market than respecting the contract. Since you have choice not to execute the contract, you will simply tear the contract, throw it, and go and sell your asset in the market if the strike price is less than ST. If it is more than ST, yes, you are in profit. Therefore, you will go to sell it with your counterpart of the contract. Okay, so these are something that you have to keep in mind. You have to clearly understand it. Otherwise, it will keep on confusing you. Now I'll come to European and American. As I told, we have an expiration date. Okay, so European option means you have to wait till the expiration date if you want to execute the contract. In American option, you have one more level of advantage for the buyer, that if the buyer thinks that he wants to execute the contract at any time before capital T, he has the option to do that. Okay, so that is American option. Therefore, in American option, the buyer has more flexibility than European option. Okay, so that is why generally American option price will be little more than the European counterpart. Okay, so the question is, what is the advantage of options? Well, if I want to buy something, I will go to market today and buy. Why will I make a contract for some time in future? And for that, I have to pay some money extra today. Why all this complications. Why can't we just have a very simple idea of, if I want to buy some stock, say Reliance of Infosys, I just go to the cash market. This is called cash market or spot market. I'll just go to spot market and buy it and put it in my bag and come back. Why will I just make a contract for future? So this is called the leverage. Okay, so in options you have the leverage opportunity. Let me explain what is meant by leverage through a simple example. Assume that that a stock is trading in the spot market, that is in the actual market, cash market, it is called, at 1,950 per share, say on 1st of February, maybe 2022. Okay, and the same stock was also trading at 2,150 on 25th of February. That is at the end of the month. Okay, so this is something which you don't know on the 1st of February. Okay, only on 25th of February you will know this information. But on 1st of February, you only have this information. Assume that our friend Mr. Meg just predicted that, okay, this stock will go up by the end of the month. Therefore, he is interested to buy 100 shares of the stock on 1st of February. Therefore, he paid 1,95,000. Okay, and bought 100 shares in the spot market on 1st of February. Now, as he expected, on 25th of February, the stock went to 2,150, and thereby on 25th of February, say he sold all his holdings and got the profit of 20,000, right? That amounts to 10.26% in his capital. The same thing can also be done in a different way. Let us call another person, Mrs. Sahana. She also predicted, yes, this stock is going to go up. But unlike Mr. Meg, Mrs. Sahana went to option market, bought a call option. So thereby what she is doing on 1st of February, she is not buying the stocks physically in the spot market. Rather, she is buying a call option contract, the same 100 shares call option she bought, okay, with maturity as 25th February. For that, she paid 50 rupees each share. Okay, so Mr. Meg paid 1,950 and bought the stocks physically. Okay, whereas Mrs. Sahana did not pay 1,950 and therefore she did not buy the stocks physically, but she bought a contract which says that she can buy this stock on 25th of February for the same price, 1,950. For that, she paid a premium 50 rupees today. Okay. Just imagine that on 25th February, if the stock price was, say, 1,900 and even 1 rupee less, 49, okay, then her contract will go worthless because her strike price is 1,950. The market price is 1 rupee less. Therefore, strike price K is greater than S. Therefore, her contract will not get executed. So it will go worthless on 25th February. So even 1 rupee, why 1 rupee, even say 1 pies, 5 pies, for instance, less than 1,950, Mrs. Sahana will lose all her 50 rupees. Okay, thereby she will be having 100% loss. But just imagine that the price of the stock was as her prediction went up. Then what happens? Let us see. Before that, we'll see that she wanted to buy 100 shares. Therefore, the premium itself she paid 5,000. Remember, this 5,000 is not going to fetch her even 1 share of the stock. Okay, it is just the contract. If her prediction goes wrong, she will lose all this 5,000 rupees because the seller of the contract will not give back the money paid as premium. Okay. On the expiration date, well, we assume that it is going to be 2,150. Therefore, just like Meg, she also got 20,000. Meg also got 20,000, and Sahana also got 20,000 on the expiration date. Okay. But you see, okay, in the absolute sense, both of them got same money as the award for their prediction. But what is the gain that she got is actually 15,000, because she got 20,000. Out of that, 5,000 she paid as the premium, right? So she got 15,000 as the net profit from this deal, and that amounts to be 300% in her initial investment. So Meg got 20,000, all 20,000 to his pocket, right? At the end of the day, he got 20,000 to his pocket, but Mrs. Sahana got only 15,000 because she already lost 5,000 in the name of premium. Therefore, her profit is only 15,000 in this deal, which is 5,000 less than Mr. Meg. But the percentage-wise, if you see, she got 300% profit, whereas Meg got only 10% profit because his investment was 1.95 lakhs, whereas her investment is 5,000. So spending less and getting a lot in terms of percentage is what generally is called the leverage. Okay, so it's like, you know, lifting something very heavy without putting much effort. Okay, so that is the idea of options. It is highly risky and highly rewarded also. Highly risky. You can see that if Mrs. Sahana's prediction went wrong, she lost 100%. You can see, suppose if the market if the market price of the asset on 25th of February is 1,949, then hardly Mr. Meg lost 100 rupees because he bought 100 shares, each lost 1 rupee. Therefore, he lost only 100 rupees, but she lost 5,000 rupees. Okay, so that's life. If you want to get more money, you have to take a lot of risk. Option is that. Okay. Well, I will show you on the real time trading of options. Okay, so you can go to Google and type option chains, and you will be shown the NSE National Stock Exchange site as the first hit in the Google. You just click it. Okay, and you can see my mouse is running very low in its battery. Okay, so it opens this table. Okay. I will just quickly explain what it is. Okay, here you can put anything that you want. See, your options are traded. That is, the underlying asset can be index. You have many index in National Stock Exchange. One main thing is the Nifty index. Next is Bank Nifty. And another, if you don't want to trade in Nifty or any other thing, you also have stocks. Okay, say for instance, you can take HDFC Bank as the underlying asset. Okay, and you have to also mention what is the expiration date. In our thing, we call it as capital T, right? So let's take it as so generally it is the last week. Thursday will be the expiration day, the monthly expiration. Okay, for stocks you have only monthly expirations, whereas for index you have weekly expiration, in which case it is every week Thursday. And if the last week Thursday is a holiday, then previous week Thursday will be the expiration day. Okay, like that it goes. Okay, so let me just show you Nifty as the underlying asset. Okay, so Nifty at present is trading, Nifty doesn't trade in spot market, but its value is 16,558. Okay, and they indicate near about that price. Okay, with some different colors you can see. So if you come to this table, you have strike prices shown here. So you have different strike prices. So in our notation, we call it as K. Okay. So the strike price, which is very close to the spot price, is what is here. And you have this slight gray color that is going to be the in the money, okay, for the call option. So the left side of this column, strike price column, is the call option, and the right side is the put option. Okay, so there are many other parameters. For us, what is important is this LTP. LTP means lost traded price. That is the premium which we call, right? So you have to pay the premium to own this contract, I said. Now, so that premium is what is listed here for different strike price. Suppose your strike price K is equal to 16,550, which is rather very close to the spot price. Okay. If you go for this 16,550 strike call option, then you have to pay 187 rupees to own that contract, and that contract will expire on 3rd March. Now let us choose 31st March and see how this price looks like. So on 31st, the same contract is trading at 543. So that is what is the premium that you have to pay to own the contract of selling. A lot size of Nifty is 50. Therefore, you have to, if you are in the call option, then it is that you have to buy 50 shares of Nifty on 31st of March. Okay. What is the strike price? 16,550. And for that, you will pay to the seller of this contract 543 rupees. Same if you take put option, it is 529.39. You can see here. That is what the put option is charging you. Let me just try to maximize its font little bit. Okay, so this is what we say here as K. This K is what is listed here. You have different strike prices. You can choose any K from this table. Okay, and you have to pay the premium for that. That premium is what is listed as lost traded price for call option this side and lost traded price for put option this side. So this column. So these two columns are very important. There are other columns which you can just see, okay, and understand. For our course, they are not that important. Therefore, I am not going for that. Implied volatility may be little important. We'll come to that later. But for trading, everything else is important, especially open interest is also very important, which is the first column of this and the last column for the put option. But in our course, we will not talk about open interest and all. Okay, so now what I will do is see what you are seeing, carefully see. You are seeing for 31st March expiry. That is almost 1 month later, you are going to go for a contract. Okay, all these things are in the money. See, the colored ones are in the money options. In the call option, these are all in the money. For put option, these are all in the money, whereas white color are out of the money options. Okay, so they have indicated them in a different color. Okay, just imagine, just remember 16,550 is trading at 543 call option. Now I will just reduce the expiration date. So now instead of choosing 1 month away as expiration date, I will just choose 3rd March, that is which is going to be day after tomorrow, right? Nifty is a weekly expiry is there. So next coming Thursday is the expiry. You can see the same strike price. Okay, now it has shifted from 16,550 to 16,600. That is because the Nifty has increased a little bit. Okay, therefore 16,600 also came in the money. Okay, so we were talking just 2 minutes before 16,550 as our interest in buying call option. In the month end, it was trading at 540 nearly, but for day after tomorrow, it is trading at 198. It's much less if you go for the expiration just 2 days later, but it is more when you go for a longer expiration. So that shows that this price, that is premium for the contract, has a time value. Okay, so that is what I'm trying to say in the next slide. We have 2 levels of values which you are paying in the name of the premium. One is intrinsic value. What is the intrinsic value? Intrinsic value is nothing but the difference between the strike price and the spot price. Okay, the sign has to be decided depending on whether you are going for call option or put option. Okay, suppose you are going for call option 16,550. Okay, then you see spot price is 16,600. Therefore, there is a difference of 50 rupees. By buying this option, you are right away having the advantage of gaining 50 rupees. Okay, because in the spot market it is 16,600, but you are going for a strike price of 16,550. Therefore, you are right away at a profit of 50 rupees. So at least that much you have to pay as a premium, right? So that is called the intrinsic value which is involved in the premium. Okay, so surely that option will be greater than 50 rupees. Here it is 198 rupees. Okay, so this was 190, this is 198 rupees. Okay, intrinsic value is 50 rupees. That is nothing but the difference between the spot and the strike price. And what is therefore the time value? Time value is nothing but the difference between these two is the time value. Okay, so this is perhaps 48, right? So that is the time value that you are getting. Okay, you have to pay if you are a buyer. If you are a seller, you are getting that money. Okay, so it was trading at 198.45 when this strike price is 16,550, right? Of course, the price will vary as the underlying assets price varies, because intrinsic value will be different, right? Let me just refresh and see what happened to Nifty right now. Nifty fell around 20 points. Okay, so if you would have bought, you see, but still, you see, that's it fell around 20 rupees, but its premium got hiked by around 7 rupees. So it means its intrinsic value went down, but its option price went up. Means time value went up. This may be interpreted as the increase in the confidence among buyers that Nifty will be way above 16,550 at the time of expiration. Whatever may be the interpretation, well, this is not important for us, but what we understand here is that an option price is a quite complicated random process. It has randomness in intrinsic value through its underlying asset is having randomness, right? So option price has two levels of randomness. One is the randomness coming due to the underlying assets price, which is through the intrinsic value, and it also has randomness in the time value. You see, just 2 minutes before, you had less intrinsic value, but the underlying assets value went down, but time value went up. So how will you even correlate? It is very complicated. There are a lot of speculators trading in the market. So more than any interpretation, it is just a spontaneous random reaction that the traders have at this point of time, which brings in the randomness in the time value. So as I told, the time value is nothing but the option price minus the intrinsic value. So this is the intrinsic value, you can say. Intrinsic value is 0 for the out of the money. So if you go for any of these guys in the call side, these all are out of the money. So for out of the money options, call options or put option, whatever it is, the intrinsic value is 0. You have only time value. You see, there is no intrinsic value in this because the market is trading at say 16,600. And suppose you are buying a call option for 16,700. Right away, you are at a loss of 100 rupees. Okay, therefore, there is no intrinsic value if you go for this strike price. Okay. Rather, it has time value. Therefore, this is purely 126 rupees it is trading at present. It is purely a time value. Okay. So, therefore, you have to keep in mind that. So, time value is also quite complicated. Okay. So, this is how the option price is actually structured. Okay. In the now we have to go to understand how this option price changes as the underlying asset changes. See, this underlying asset changes its value every fraction of second. Let me refresh once again and see. We had 16,554. Now it is 16,616. Okay, so it just keep changing random. Okay, correspondingly, this strike price which we were interested, it also changes. See, you just imagine that if you would have bought just 5 minutes before we were talking, it was trading at 198. Now it is trading at 209 per share. So roughly we gained 11 rupees in the trade if we would have taken a long position in this call option just 5 minutes before. Say if we would have bought contracts for 1000 Nifty shares, means we have to buy 20 contracts. Remember, one contract in Nifty equals 50 shares of Nifty. That is, the lot size of one contract in Nifty is 50 shares. Therefore, if we want to trade 1000 Nifty shares, we have to buy 20 call options. Then we would have spent 198 into 1000, which is equal to 1,98,000 rupees, and we would have got 209 into 1000, which is 2,09,000, which means we got the profit of 11,000 rupees, that is 5.56% in our initial investment within 5 minutes. So this is the kind of leverage that we have in options, but you should also remember that if the price would have gone little down, you would have also lost several thousands within minutes. The same opposite will happen for the put option. Just if you understand whatever you understand with call option, more or less the opposite of it will happen to the put option. Okay, therefore one need not explain it, but as a student you should sit and also understand it, what will happen correspondingly to put options. Okay. So now our task is to understand this price movement of the option based on its underlying assets price. Okay. How when underlying asset price changes, the option price changes. That is our interest for this throughout this course. And later at the end of the course, we will also see how to make use of this option price to hedge our portfolios. That also we will see at the end of this course. But our first task is to understand this option price. So in the immediate next section, we will study how these option prices have bounds. Okay, they trade between certain values. Okay, we will first understand that, and then we will probably go later on to the pricing models. Okay, we will use binomial pricing model, which is at the discrete time level, which we already know. It's not something which is new to you. You already know binomial pricing model for the underlying asset. Okay, in the name of stocks, we have understood it. Here also more or less we will do with stocks only. There's nothing much difference between stocks and any other assets. Okay, so therefore that should not be very difficult to understand if you understand stocks. Therefore we will just fix with stocks and do all this. So first we will do the binomial pricing model, which is at the discrete time level, and then we will go on to continuous time level, which will be the Black-Scholes model. Okay, that is something idea is something equivalent to the log normal model that we studied for stocks. So in that sense, we are almost 50% already familiar with all this. We have to only learn something new which is coming through this option pricing. It's not so easy, of course, it's difficult. So that is what we will be doing in the coming weeks.